All right, if you're a trader, I bet you know the moving average. I mean, it's the bread and butter of technical analysis, right? That simple line on your chart. But what if that very tool, the one you rely on every single day, is actually sabotaging your trades? Well, today we're going to dig into a much smarter way to track the market. And look, this isn't just some hypothetical question. The flaws in standard moving averages, they're very real, and they can absolutely cost you money. We're talking late entries, late exits. But what if? What if there was an indicator that could almost think for itself, something smarter, faster, and way more in tune with the market's every move? Yeah, that's exactly what we're here to check out.
So, here's the game plan. We'll start with the moving average dilemma, the core problem. Then we'll look at the two flawed tools most of us use. After that, we'll get to the good stuff, McGinley's Dynamic solution. We'll even take a quick peek at the formula behind it, and then wrap up by seeing why it's such a smarter tool for the markets today. Let's do it.
Okay, let's dive right in. The moving average dilemma. Look, these things are everywhere for a reason. They're great for simplifying price action and spotting trends, but they have this fundamental kind of built-in problem that can throw off some seriously misleading signals. This really gets to the heart of the trade-off. Think about it. A long-term average, say a 50-day, gives you this beautiful, smooth line. It's great at filtering out all the little market noise. But the catch? It's slow. So slow, in fact, that by the time it finally signals a trend change, the price could have already taken off without you. On the flip side, a short-term average is way faster, but it's so choppy it's like trying to read a signal in a storm. And that, right there, is the core of the problem. Okay, so this brings us to the two usual suspects, the simple moving average, the SMA, and the exponential moving average, or EMA. I mean, you see these on pretty much every trading platform out there, but as we're about to see, each one has its own baggage. All right, first up is the SMA. It's the classic, right? But it's just often too slow for today's fast-paced markets. Prices can make a huge move before the SMA even blinks, and that means you're getting in late on a winner, or even worse, getting out late on a loser. So the EMA comes along and tries to fix this. It gives more weight to the newest prices, which makes it faster. But in its rush, it can totally overreact to tiny price swings and just kind of forget about important older data, which, you guessed it, creates a whole new set of false signals. And this right here, this is the real-world frustration for so many traders. The market isn't static, right? It speeds up, it slows down. So how on earth do you decide when to use a 10-day or a 20-day or a 50-day average? It's basically guesswork. You're trying to use this rigid, fixed tool on something that's constantly changing. It just doesn't make sense. So this is where our hero enters the picture. A guy named John R. McGinley, a chartered market technician. He saw this exact problem play out day in and day out. He got so frustrated with the flaws of the moving averages that everyone was using, he basically went on a quest to build something way, way better. And this quote from him, it really shows a total shift in thinking. McGinley's point was that traders were using moving averages completely wrong. They aren't magic crystal balls spitting out perfect buy and sell signals. No. He said their only real job is to be a smoother, a tool that just accurately reflects the price. And he wanted to make that tool perfect. And so here it is, his solution, the McGinley Dynamic. And let me be clear, this isn't just another moving average with a slightly tweaked calculation. No way. This thing was designed from the ground up to solve that exact speed problem we've been talking about. Its main job, to hug the price line as closely as humanly possible, no matter what the market is doing. So you're probably wondering, how does it do that? How does it adapt so well? Well, the secret isn't magic, it's math. All the power is baked right into its unique, self-adjusting formula. Okay, whoa, don't let the formula scare you. We are not going to sit here and do the math. The important thing is to understand what the math does. See that last little bit at the end? The part that compares the closing price to the indicator's value? That's the secret sauce. It acts like an automatic gas pedal and brake. It's constantly measuring how far the price is from the line. The bigger that gap gets, the faster the indicator moves to catch up. Simple as that.
The best way to think about it is like this. The McGinley Dynamic is like having a super advanced power steering system for your trading. It doesn't matter if you're on a slow, straight road or a crazy winding racetrack, it automatically adjusts to keep you glued to the road, or in our case, glued to the price. It just knows when to be super responsive and when to smooth things out.
And here's what that looks like in the real world, which is just beautiful. When the market is dropping hard and you need to get out fast to protect your money, the indicator speeds up, following the price right down. But when the market is in a nice, steady uptrend, it automatically slows down. This gives you a smoother line, which helps you avoid getting shaken out by every little dip. You know that frustrating thing called a whipsaw, where a fast indicator tells you to sell right before the price shoots up again? Yeah, this helps avoid that.
So let's bring it all home. What does this actually mean for you, the trader? What are the real-world benefits of using a smarter tool like this?
Well, it basically tackles every single problem we talked about at the beginning. It adjusts to market speed all by itself, so you can stop guessing which period to use. It hugs prices super closely, getting rid of those dangerous gaps and lag you get with SMAs. And because it does all that, it seriously cuts down on whipsaws and false signals, making it a much, much more reliable tool for timing your entries and exits.
So I'll just leave you with this one question. We all know the market is dynamic, right? It's a living, breathing thing that's always changing speed. The McGinley Dynamic was built specifically for that reality. So you have to ask yourself, are the tools you're using built for the market of yesterday, or are they dynamic enough for the market of today?